Welcome to this deep dive. Today we're exploring a crypto project that's built this huge user base, really unlike almost any other. But it's also generated a lot of questions, a lot of debate. Pi Network, the one promising you can mine crypto right there on your phone.
That's the one. It's definitely pulled in tens of millions of users, mostly with that promise of, easy digital currency.
Yeah.
But as the source we're digging into today shows, there are a lot of layers to Pi Network that aren't obvious right away.
Exactly. So our mission here is to go through this one detailed analysis we have from Coin Bureau and really pull out the key insights.
Okay.
We want to understand everything this source tells us about Pi Network, where it came from, how it works, its potential maybe, and also some pretty surprising challenges it faces. And we're sticking strictly to what's in this source.
Right. And just the scale of Pi Network, especially those claimed user numbers, makes it a really fascinating case study in crypto, doesn't it?
It really does. So let's dive into what this source has uncovered.
Let's do it.
Okay, so starting at the beginning, where did Pi Network come from? The source tells us it officially launched back in March 2019.
Yeah, but it was actually being built kind of in stealth mode since at least September 2018.
Okay.
And what's interesting from the source about its foundation is the core idea. Apparently, the founders looked at how social media, like Facebook, got huge by using real identities.
Right.
So they aimed to make getting users into crypto really easy and compliant from the get-go. The source calls it a SocialFi project, kind of blending social networking with decentralized finance ideas.
So bringing that real-world identity into crypto, the source actually compares it, saying Pi Network is sort of a mix of Worldcoin.
Which is pretty controversial. Yeah, the eyeball standing.
Right, and Notcoin, where you just tap to earn.
Yeah.
But Pi Network actually came before both of them.
And speaking of origins, this is where the source drops one of the first really surprising details.
Oh, yeah.
Well, the public face was usually two co-founders, Nicholas Kokalis and Chengdao Fan, both Stanford grads. But the source found evidence there were actually four initial co-founders.
Four? Okay, who are the others?
Also Stanford grads, Vincent McPhillip and Aurelian Schultz.
And the source digs into this more, right? It found a lawsuit from 2020.
Exactly. Vincent McPhillip apparently sued Nicholas and Chengdao. He alleged he was unfairly fired.
Wow.
Yeah, and the source says this lawsuit was reportedly settled in 2023, but finding info on it now is, well, surprisingly tough.
Why is that?
The source speculates it might be because the lawsuit potentially revealed some, sensitive operational details about Pi Network.
Okay, but what key information did come out from that lawsuit, according to the source?
The source highlights that the lawsuit documents suggested Pi Network raised at least $800,000 from investors.
$800,000. When was this?
Between 2019 and 2020.
Wait a second. $800,000 raised? Because the source points out that this seems to contradict what Chengdao claimed even recently, like February 2025.
Yeah.
That Pi Network never raised any money through an ICO.
Right, and the source is careful here. It suggests, well, it's possible Chengdao's claim is technically true.
How so?
Maybe the funding came from selling shares in the company behind Pi, Social Chain Inc., not selling Pi tokens directly in an ICO.
A technicality.
Possibly. The source notes Nicholas Kokalis argued back in 2017 that selling shares was maybe better than an ICO anyway, but still, the lawsuit detail definitely flags a potential difference between public statements and, early reality.
That's fascinating detail to come out of a lawsuit. So Vincent's gone, but what about the fourth founder, Aurelian Schultz?
The source says he's still a core developer. He's listed as director of engineering, active on GitHub, but keeps a very, very low profile.
So this history, the stealth start, the quiet lawsuit, the low profile, it seems to point to something the source mentions.
Yeah, a significant lack of transparency. The source uses the word opaque. They point to infrequent updates, even on places like X, like only 700 posts since 2019.
That's not a lot.
No. And it seems many early updates, especially any involving Vincent, might have been deleted.
Interesting. But despite that opacity, the source didn't find, major holes in the overall story.
No, they note the founders have been pretty consistent about the origin story itself.
Right.
The Stanford connection, the goal of easy crypto onboarding.
Okay. And the Pi coins themselves, they weren't really real until the main launch, right? December 2021.
Correct. But even then, you couldn't trade them on exchanges until much later, February 2025.
Why the long delay?
According to Pi Network, it was all about making sure everyone getting Pi was a genuine person, which led to that mandatory KYC Know Your Customer requirement to actually claim your mined Pi.
And that KYC step had a massive outcome, didn't it, according to the source?
Yeah, Pi Network's website claims over 14 million users have completed KYC.
14 million verified users.
The source points out that technically this gives Pi Network the highest number of verified users of any crypto project out there. And they suggest this could actually become a huge selling point down the line, especially as the industry maybe moves towards more regulation or focus on real users.
Okay, so that's the origin story. Let's shift gears. How does Pi Network actually function, like under the hood? And what's this potential catch the source identifies?
All right. So the source explains the Pi Network blockchain uses a modified version of the Stellar Consensus Protocol, SCP, that relies on trusted nodes and validators to agree on transactions.
And the network claims some pretty high speeds, right? Like 70,000 transactions per second.
That's the claim, yeah. But the source is pretty skeptical about that number.
Why?
They point out that the base Stellar network itself usually only handles a few thousand transactions per second. So that huge difference suggests, according to the source's analysis, that Pi's network might be, well, extremely centralized.
Centralized. How so?
Possibly as a trade-off to get that claim scalability. And the source actually points to data from the PyScan Explorer to back this up.
What does it show?
It apparently shows the network has just 28 active nodes.
Only 28.
Yeah, and only 3 validators. And the striking detail, all 3 validators are listed as being run by the core team.
Wow, okay. So basically run by the founders.
That's what it looks like. And this apparent centralization, the source suggests, is probably a big reason Pi has struggled to get listed on major crypto exchanges.
Because exchanges want decentralized projects.
Exactly. Otherwise, it's functionally just like a centralized database controlled by one company, which kind of defeats the purpose of blockchain for many.
Right. Undermines that core crypto idea.
Yeah.
And because it uses SCP, there aren't typical staking rewards, are there?
Correct. No rewards at the blockchain level for locking up Pi. The rewards come purely from that mining activity in the app.
So you get a base rate, like 0.09 Pi a day now.
Yeah.
You can boost it with referrals and stuff.
Yep. That's the basic mechanism.
Okay, now, according to the source, this is where the purpose of that mining gets really, really interesting. The white paper says app mining doesn't help consensus unless you run a full node. Its stated purpose is just proving you're human daily, validating your presence.
Right, that's the official line. But the source's analysis suggests, well, that might only be part of the picture.
Go on.
The original network idea came from Vincent McPhillip, remember? But the incentive, the mining reward part, seems heavily influenced by Cheng Dao.
Right.
And Cheng Dao's background, maybe surprisingly, is in anthropology.
Anthropology. That is unexpected for a crypto founder. How does the source connect that to the mining?
They highlight a video from March 2020. In it, Vincent and Cheng Dao apparently revealed they were closely watching how users exchanged Pi tokens within the app.
Watching user behavior.
Specifically, what people would be willing to give up or do in exchange for getting those Pi tokens.
Ah. So the source is suggesting the mining rewards were set up, partly at least, as a kind of behavioral experiment.
Precisely. That's the source's interpretation, that Pi mining is essentially an experiment to see what value users place on Pi, measured by what they're willing to exchange for it.
And based on what we discussed earlier, it seems users have been willing to exchange quite a bit, including detailed personal ID and info via that mandatory KYC.
Exactly. And Pi Network uses its own custom-built KYC solution.
Right. Why did they build their own?
Well, in a March 2022 interview, Cheng Dao and Nicholas claimed it was because third-party KYC companies couldn't handle their user volume.
But the source doubts that claim.
Yeah, they question it strongly. They point out that established KYC firms handle hundreds of millions of checks for huge exchanges all the time without any problem.
So what's the source's alternative theory?
Their analysis suggests a different possibility. Maybe Pi Network built its own KYC to gain access to and potentially even sell detailed user data.
Sell user data. Is there evidence for that?
The source points to the privacy policy of Social Chain Inc. That's the California company behind Pi. It apparently states explicitly that personal information can be disclosed to subsidiaries and corporate affiliates.
So reading between the lines, the source thinks Pi Network could legally be selling user data to related companies.
That's the potential implication flagged by the source. They mention things like a Pi ad network campaign where advertisers pay in Pi for ad space in Pi apps.
Ah,
And they speculate, though they couldn't confirm it, that those ads are probably curated based on the user details gathered during KYC.
makes sense. The network has quite a few apps now, right? Over 70.
Reportedly, yes,
Yeah.
including the KYC app itself. The most prominent seems to be the Fireside Forum.
What's that?
It's a social media platform launched by the Pi team in 2023. It seems to be the main place for official info and user interaction now.
And another detail about developers.
Yes, the source notes all developers who want to build apps on Pi Network also have to complete the KYC process themselves.
Interesting. And Pi Network recently announced a venture fund.
Yeah, Pi Network Ventures, a $100 million fund, a mix of USD and Pi coins to encourage more app development.
Okay.
But the source points out something odd in the announcement. It says the fund is established through the Pi Foundation, which it describes as an ownerless organization.
An ownerless organization.
Yeah,
But didn't the white paper call the foundation a nonprofit?
exactly. There's a discrepancy there. The source believes the actual legal entity is probably the Pi Community Company, which is based in the Cayman Islands.
Why the Caymans?
The source notes this is a pretty common setup for crypto projects. It can potentially help navigate or, minimize regulatory issues, especially around issuing tokens.
Okay, that's a lot on how it works and some potential catches. Let's shift to the token itself, Pi. Its tokenomic supply, distribution, all that. And then the challenges the source sees.
All right, so Pi is the native crypto. It's meant for transaction fees, paying for stuff inside Pi apps, and as we mentioned, paying for ads on their network.
Got it. And wasn't there something about fees being burned?
Yeah. The source notes Nicholas Kokalis said in an April 2021 video that transaction fees would be removed from supply. But apparently that doesn't seem to be happening right now.
What was the total supply?
According to a blog post, the source cites the maximum supply is 100 billion Pi.
100 billion. How's it allocated?
The breakdown is 65% is earmarked for mining rewards over time, 20% goes to the team, 10% to the foundation, and 5% is set aside for liquidity.
Okay.
And these percentages are maintained as Pi gets mined and moved to the mainnet.
So where are we now with that? How much has actually been mined and migrated?
According to the official Pi Network Explorer the source looked at, about 7.2 billion Pi have been mined and migrated so far.
7.2 billion out of the 65 billion for mining.
Right.
So just over 10% of the mining allocation.
Right. And logically, based on those percentages, that means the team and foundation should have received about 3 billion of their vested Pi allocation by now.
Okay, 3 billion for Team Foundation, 7.2 billion migrated from miners. Now, here's where the source's analysis of supply gets really critical, isn't it?
Yes. This is key. They point out that most of the circulating supply, the Pi, that's actually on the mainnet, seems to be controlled directly or indirectly by the team.
How does that work?
Well, even though 7.2 billion Pi have been migrated, the source states that only about 2 billion of that is currently unlocked.
Unlocked meaning?
Meaning it's freely available for users to transfer or for exchanges to hold. The rest is still locked up under various conditions.
Okay, so only 2 billion unlocked for users.
Meanwhile, the source calculates that over 3 billion Pi coins have already been unlocked and released to the team and the foundation wallets.
Wait, so the team and foundation control more of the unlocked, freely circulating Pi than all the millions of users combined?
That's exactly the conclusion the source draws. And they suggest this heavy team control over the actual available supply could explain something that's puzzled a lot of people.
Which is?
Why Pi's price didn't just completely collapse. I mean, you airdrop tokens to tens of millions of people who've waited years.
You'd expect massive selling pressure.
Right. Many expected the price to go straight towards zero. The source argues the reason it hasn't or hasn't crashed more likely lies in these specific details about who actually controls the unlocked supply. The devil's in the details, as they say.
And part of those details is low liquidity on exchanges, right? What does that mean?
Yeah, liquidity is just how easily you can buy or sell something without moving the price too much. According to the PiScan data the source used, exchanges hold only about 300 million Pi in their known wallets.
300 million. Compared to 2 billion unlocked circulating supply.
Exactly. The exchange liquidity is tiny, like over 20 times smaller than the supposed unlocked supply.
So low liquidity means the price is easier to move.
Much easier. A relatively small amount of selling can push the price down hard, and buying can push it up quickly. It makes the price more volatile and potentially easier to manipulate.
Manipulate? How?
The source suggests it's possible Pi Network might be selling Pi OTC over the counter privately and then using the money, maybe with market makers, to influence the price on exchanges.
Is there proof of that?
They mentioned seeing some on-chain transfers from Pi Foundation wallets to exchanges on PiScan, but admit these transfers haven't been huge.
Okay.
But the big worry is, with liquidity that low, even small amounts of selling, whether from users finally unlocking their Pi or from team wallets, could still cause a pretty big price drop.
Which brings us to the $1 million or maybe the $5 question. How high does the source think PiCoin could actually go, given all this?
Well, this is where it gets wild. Ultimately, the source suggests the price might depend heavily on whether this potential manipulation is happening and how well it works.
So if it is heavily managed,
it could theoretically go higher than fundamentals would suggest. From a purely technical chart perspective, the source notes it could potentially rally as high as $5.
$5 per Pi. Based on everything you just said about supply control and low liquidity, that sounds
ambitious.
It sounds very ambitious. The source acknowledges this. At $5 per Pi, the market cap would be over $30 billion.
Yeah.
But the fully diluted market cap,
meaning if all 100 billion Pi existed, would be over $500 billion. $500 billion.
$500 billion.
Yeah.
For Pi Network. That seems, well, the source uses the word insane.
Yeah, it's in the territory of the world's largest companies. But, and this is the source's key point, they argue that the extremely low liquidity on exchanges could theoretically make a $5 price achievable in a thin, potentially manipulated market, even if that fully diluted number looks completely out of whack from a traditional viewpoint.
So $5 is maybe technically possible under very specific, maybe artificial conditions. But what about the fundamental potential, based on actual use and development?
Fundamentally, the source says potential hinges on hitting upcoming milestones. Key ones could trigger price bumps.
Like what?
Like making it easier for users, the pioneers, to migrate more of their mined Pi to the mainnet. Right now, it involves complex lockup periods.
Okay.
Also, making it possible to convert those Fireside tokens from the social app into actual Pi coins.
Yeah.
That could mean more Pi for users, but also potentially for the team and affiliates. And generally improving things for developers.
But the source mentions issues with the roadmap.
Yeah, they note some milestones seem technically met, but the overall roadmap feels out of date, which circles back to that communication problem.
Right, the infrequent updates?
It's a real issue. The source points to millions of views on unofficial YouTube videos and things, as users are desperately trying to find information, especially about how to get their coins migrated and unlocked.
That lack of clarity seems like a major hurdle. Which leads us nicely into the main challenges the source identifies for Pi Network. What's the first one?
It's exactly that. Lack of transparency and communication.
Like that ownerless organization launching a $100 million fund.
Exactly. The source finds that kind of language suspicious, even for crypto. The biggest black holes seem to involve money. Who were the original investors? Were there other funding rounds? Are they selling Pi OTC now?
And the source says they need to answer these for legitimacy.
Pretty much. They call Pi Network an extreme example of crypto opacity, but they do stress this part is fixable with better communication.
Okay, challenge number 1, transparency. What's number 2?
Tokenomics. Specifically, that massive potential imbalance between supply and demand.
Too much Pi waiting to be sold, not enough buyers?
Essentially, yes. You have a huge overhang of supply from pioneers who've mined for years, plus the team's allocation versus very few places to easily buy it and low demand.
Right.
And while transparency helps, Pi has this weird linked problem. The mining incentivizes using the app daily, right? But the Pi you've earned isn't the same as Pi you can sell. It's locked.
Locked Pi is worthless until unlocked.
Exactly. And if too much unlocks at once, the price crashes. So the source suggests the Pi team might be actively managing this, controlling the supply, hitting the market by adjusting the rules for migrating and unlocking Pi.
Almost like turning a tap on and off.
Kinda. And the source speculates on why they might be doing this, managing the supply and potentially the price.
What's the potential motivation?
It could be to keep pioneers engaged, to make them think, okay, the price isn't crashing, maybe it's going up. If I just keep clicking that button and wait a little longer, I'll get rich. It's a psychological hook.
That makes a kind of sense. Okay, transparency, tokenomics.
Yeah.
What's the third challenge?
Broader appeal, especially to institutions.
How so?
Theoretically, Pi's big selling point could be those 14 million plus KYC'd users. That sounds great to advertisers. Or maybe for future apps needing real verified people, perhaps involving regulated assets.
But there's a catch.
The catch is, this assumes Pi's in-house KYC process is actually legitimate and accurate, and the source really questions this.
They doubt the 14 million number is real.
They raise the possibility it might not be totally airtight. They speculate about potential issues like maybe millions of fake accounts somehow getting through KYC.
Fake accounts.
The source makes a stark point here. They suggest having millions of fake verified accounts might even be preferable to having real users' personal data leaked, which, they mention, allegedly happened to about 10,000 Vietnamese users back in 2021, although that involved a third-party service, not Pi's own KYC.
So the possibility of inflated numbers, plus the fact that maybe most pioneers aren't really active beyond clicking the mine button,
means serious institutions looking for genuinely engaged, verified users would probably steer clear.
makes sense.
Plus, those institutions would likely have to go through Pi's own KYC process too, which adds another layer of hesitation. The source suggests this KYC uncertainty is probably another reason for the limited exchange listings. Major exchanges do their homework on this stuff.
Okay, so summing up the potential. Despite all these challenges, some people do see potential in Pi, right? Because it combines bits of Worldcoin and Notcoin.
Yeah, that comparison comes up. It hit that mine on your phone idea early, and it has the social angle.
But what's the source's overall take on that potential?
It's pretty sobering, honestly. They point out that neither Worldcoin nor Notcoin are exactly seen as slam-dunk investments by most of the serious crypto community. So the source concludes that even if Pi does manage to fix its transparency and communication issues, the actual potential for the Pi coin itself is likely quite limited compared to other crypto projects out there.
There's one exception they note, though.
Ah, yes. If you're one of those pioneers who's been clicking the button and mining Pi, well, for you, it's basically free money, assuming you can eventually unlock and sell it, of course.
But there's always a but.
Always. The source immediately follows that with the old saying, if something is free, you are usually the product.
And given everything the source raised about the KYC, the privacy policy, the potential data use, it hits hard here.
It really does. It's a very sobering thought in the context of Pi Network, based on this analysis.
So wrapping this all up, what does this deep dive into the source material on Pi Network really mean for you, the listener?
Pi Network is definitely unique. That massive user base, the app mining, the social fi focus, it stands out. Absolutely. And as the source analysis shows, looking closely at Pi Network really highlights some critical issues and common challenges you see across the whole crypto space.
Like what specifically?
Issues around transparency or the lack of it, that constant tension between centralization, like we saw with the nodes, and true decentralization.
Yeah.
The complexities of tokenomics, how supply can be controlled, who benefits.
And the whole KYC aspect, too.
Definitely. The challenges and questions around user verification, data privacy, and how market prices can potentially be influenced by things other than just pure supply and demand. Understanding Pi through this lens gives you real insights into these bigger industry themes.
Yeah, this deep dive into the source material on Pi has certainly given us a lot to chew on. From those surprising origin details, the early funding questions, to the really unique, maybe experimental nature of the mining itself, the complex tokenomics with that apparent team control, and those big questions the source raises about transparency and KYC legitimacy.
Yeah, and given the source's analysis, suggesting that maybe the mining was partly an experiment about data exchange,
Right.
and that potential price management might be about keeping users hooked. Maybe consider this provocative thought as you go about your day. When you engage with projects offering something seemingly for free,
Yeah.
especially when they need a lot of your personal data and verification, what are you actually mining or exchanging in that transaction? It's something worth mulling over.
Definitely something to think about. Thank you for joining us for this deep dive. I hope it provided some valuable insights.